Good afternoon to all of you. On behalf of the Accounting Standards Board, I extend a very warm welcome to all participants to this webinar on year end considerations, income and expenditure, in days aspects for financial year 2025-26 close. As organizations approach the close of the financial year, the focus naturally moves beyond routine bookkeeping to a more critical review of how income and expenses have been recognized and reported. This stage plays a vital role in ensuring that the financial statements present a reliable and meaningful picture of the entity's performance for the period. Although the end days framework lays down clear guiding principles, their implementation at the year end often calls for careful evaluation and professional judgment. Matters such as timing and basis of revenue recognition, completeness of expense recording, appropriateness of accruals, and the impact of estimates and assumptions require close attention during the closing process. This session is designed to navigate these practical aspects. The emphasis will be on translating in days principles into application oriented insights supported by examples of areas that commonly give rise to challenges during financial close. We hope that the deliberations today will help strengthen your approach to year ending reporting and provide greater clarity in dealing with income and expenditure related considerations. Thank you for your participation, and we look forward to a productive and insightful session. We are privileged to extend a very warm welcome to our esteemed speaker for today's session, CA Sandeep Garg sir. Before we move into the technical discussion, it's my pleasure to introduce the moderator for today's webinar, CA Meenal Khemka ma'am. CA Meenal Khemka is a qualified chartered accountant and DISA professional with over a decade of experience in taxation, audit, and regulatory compliance. She has been in independent practice since 2012, advising clients on income tax, TDS, corporate compliance, and financial matters across individuals, firms, and companies. She brings strong expertise in tax planning, litigation, and representation before appellate authorities, along with the ability to resolve complex tax issues effectively. She has handled statutory audits for a diverse range of entities, including banks, educational institutions, and corporate organizations, gaining wide sectoral exposure. Over to you, Minal ma'am.
Thank you, sir. Thank you, Rahul, sir. Hello, everyone. First of all, I would like to say thanks to CA Dr. Sanjeev Kumar Singhal, Chairman of Accounting Standard Board of ICAI, and CA Vishal Joshi, sir, Vice Chairman of Accounting Standard Board of ICAI, for organizing 32 webinar on the year-end consideration, income and expenditure and as consideration for financial year 25-26 reporting. Our today's speaker is CA Sandeep Kumar Garg. I would like to introduce him. Let's have a brief introduction of our speaker. CA Sandeep Kumar Garg is a chartered accountant over 17 years of experience in a group financial reporting, controllership, Ind AS, IFRS implementation, and financial transformation across large listed and multinational organizations. He began his career in 2008 and has held leadership role with organizations such as Lanco Infratech Limited, Motherson Groups, Bharti Airtel, GMR Group, ETG Group, and Yatra Online Limited. He is currently associate with Protivity India in financial reporting and remediation practice. He has leading complex financial reporting and consolidation engagements across large and diverse group structures and has worked closely with CXOs, diversing initiative in financial closure, improvement, reporting, automation, internal control, and group restructuring, resulting faster reporting and stronger governance. He has extensive contributed to one of the widely referred publication tries on Schedule 3 authorized by CA Dr. Alok Garg, reflecting his strong technical ground in financial reporting. He is passionate about mentoring financial professionals and actively contribute to capability building through training and knowledge sharing initiatives. Throughout his career, he has been known for his integrity and unwavering commitment to deliver high quality outcomes, considering earning recognition from leadership and stakeholders. Sandeep ji is a strong advocate for continuous leading, meaningful networking, and giving back to the profession. Now, I request to our speaker to start their session and increase our knowledge.
Hi, good afternoon, everyone. Thank you, Rahul, and thank you, Meenal, for my introduction. So, first of all, I would like to pay my sincere gratitude to CA Sanjeev Kumar Singhal ji, Chairman, and the Vice Chairman, CA Vishal Doshi ji, for giving me this unique opportunity to present my views on year-end consideration, which is the topic for today's webinar as well. Right. So currently, this is very right time for this topic because we are sitting at the closing year-end closing as well as we are going to start our year-end audits as well. And most of the professionals are busy with their year closing and audit activities now. Currently in India, we have two set of standards. One is erstwhile IGAP, which we know, which is also known as accounting standards. And the new one is Indian accounting standards, commonly referred as Ind AS. Though it is introduced a decade back, so we cannot say it is new. It is into implementation for more than 10 years now, and we are into the 11th year. We have seen various phases of Ind AS, new Ind AS amendments, new Ind AS timely amendments issued by ICAI and notified by MCA as well. So the focus, which was initially on transition, has now shifted majorly on quality reporting as well as enhanced comparability across the world of our financial statements. Ind AS is applicable to all the listed entities in India, and on the basis of net worth criteria, it is applicable to unlisted companies as well. Currently, it is more than 250 crore. When Ind AS is applicable to any entity, it automatically is applicable for its group companies, being subsidiary or joint ventures and associate also, irrespective of their net worth criteria. Further, if we look at the current scenario, recently IRDAI has notified Ind AS 117 for insurance contract, which will be applicable for all the insurance company, and it is truly a remarkable decision to into the right directions. Right. I have prepared a small PPT for today's session. Let me share that. Hi, is it visible to all? Meenal, can you please confirm, Rahul?
Yes, sir. It's
Great,
visible.
great,
Visible,
great.
sir.
Thank you, thank you. So when we talk about financial reporting, we talk about financial statements, right? There is a balance sheet, there is a P&L, cash flow statement of changes in equity, and allied notes, accounting policies, disclosure, and everything. There is a full set of financial statements. But there are different regulations which are governing for different kind of industries, different kind of entities. In India, we have listed companies, unlisted companies, non-corporate entities, non-profit entities, insurance companies, banks, and various other organizations. And if we look at the applicable accounting standards, so we have Indian accounting standards, that is Ind AS. We have AS issued by ICAI. Then we have accounting standards notified by MCA. Then we have Schedule 3, Division 1, 2, and 3, and CARO 2020. So for different kind of organization, different kind of accounting principles are there. So whether we are preparing financial statements or we are reviewing or we are auditing the financial statements, we need to be well versed with all these regulations, principles, accounting standards, and recent changes and amendments. So that while preparing, we know what we are doing, what are the latest amendments, and how our financials are going to impact our entity as well as to the stakeholders who will be using those financial statements for various decisions, be it bankers, FIs, investors, customers, or anything. Right. As I was talking about different kind of standards, Ind AS, which is conversed part of IFRS, which is known and accepted worldwide. So this list is for the applicable Ind AS and the corresponding IFRS and the existing IGAP Ind AS for the same. So currently we have 39 Ind AS in force, which have been notified in last 10 to 11 years in by different notifications by MCA. And we are more or less in line with IFRS with respect to only few carve-outs and carve-ins are there. If we look at it closely, our accounting standards do not have a corresponding standard with respect to Ind AS for each and every matter. Okay. And currently there is one more standard which is issued by ICAI and which is also approved and notified by NFRA. That is Ind AS 118 presentation and disclosure in financial statements, which is going to change the presentation of profit and loss statement of profit and loss completely. However, it is yet to be notified by MCA. The global counterpart of it is that is IFRS 18, which is applicable from next financial year, but the applicability date and criteria is yet to be notified by MCA, which we believe will be released shortly so that the entities have sufficient time to prepare for the same. So, as I was talking about that in India, we do not have accounting standard corresponding to each and every Ind AS or IFRS which is there in place. If we look at financial reporting in hyperinflationary economies, Ind AS 29. What is a hyperinflationary economy? Any economy which has huge inflation and the gross inflation has crossed 100% in previous 3 years, that economy is considered as hyperinflationary economy. And in these kind of economy, the historical value of the currency in which financials are presented has lost its value. They do not make any sense because inflation is increasing day by day and it has already crossed the 100% benchmark, which is required to implement this Ind AS. Why it is important in Indian perspective? Because many Indian houses, many Indian businesses, companies have their operations in economies which are going through the hyperinflationary, like it was Zimbabwe till some time back, and many for African countries like Ethiopia, Ghana are on the verge or implement in the way out of their hyperinflationary economy. So AS are lacking for this concept, but Ind AS provides complete guidance into it. Then we have financial instruments. Financial, as we remember, the financial instrument talks about financial asset, financial liability, recognition of financial instruments, bifurcation into equity, liability, compound financial instrument, measurement and presentation, along with disclosure in the financial statements. In AS, we used to have AS 30, 31, and 32, which were not notified and are drawn and withdrawn long back also. So we do not have any current AS in India which deals with financial instrument. Similarly, agriculture. India was a primarily agriculture-based economy till some time back, but still we were lacking on any accounting guidance or any AS which can guide how to account for the biological assets, how to account for biological asset, when to recognize at what value these biological assets to be measured, what will be a biological asset, what will not be a biological asset. But IND-AS has agriculture, IND-AS 41, which clearly defines all the principles for the biological assets as well. If we look at share-based payment, India has only guidance note for the purpose of IND-AS, for the purpose of AS, but for IND-AS, we have IND-AS 102. Similarly, one more concept which we are hearing for last 10 to 12 years, fair value measurement. I remember the time in 2010 when Ind AS was supposed to be implemented first time. So everyone was saying the major shift from AS to Ind AS is fair value. Everything has to be fair valued. But do we have fair value concept in our existing AS? We have, but there is not a separate standard for the same. For example, AS 10 fixed assets talk about revaluation model. Similarly, AS 14 amalgamation talk about fair valuation principles to the extent relevant to amalgamation concepts, but there is not a full-fledged fair valuation standard which governs the fair valuation, how to arrive at the fair valuation, what all underlying assumptions and everything. what all disclosures need to be made for the same. But India has a separate standard for fair value measurement, which majorly covers the fair valuation requirement for most of the standards. Right. Similarly, insurance contract, which is a new thing for Indian economy and Indian companies, it is notified and we believe it will be implemented shortly within the given time frame. As we move forward, so what are the key considerations for finalization of financial statements? Right. When we start preparing financial statements, generally we look at what are the recent amendments in India, right? Since 2015, when the Indians were first notified, and we are sitting in 2020, 26. Most of the time, every year we see amendments or a new standard. For example, we have the revenue from contract, revenue from contract from customers, Ind AS 115. We have leases, the new standard replacing the old standard. Then we have now insurance contract. We have one more standard coming 118. And if we talk about amendments, almost every year we have new amendments. Why so? Ind AS is a converse part of IFRS, which is accepted globally, and the IASB, International Accounting Standard Board, which primarily issues IFRS. They keep track of all the global developments, global economies, and they keep bringing new amendments to the existing standards based on the requirement, based on the changes. And our regulatory authorities, ICAI, NAFRA, and others work on the same lines. They review those amendments, new requirements on continuous basis. And once these are finalized, considering the Indian economy, Indian environment, Indian business, these are also issued continuously as an amendment or as the new standard, as the case may be. Also, whenever any new amendment is issued or any new standard is issued, there is a implementation timeline is giving, which generally 1 year more or less, so that entities can prepare a diagnostic study how it is going to impact any industry to which India is applicable. They can prepare a diagnostic study. They can discuss with the management, with the consultant, with the auditors, what all will be changed in the method of accounting, in the preparation of financial statement, the way we look at the financial statement, we look at the various contracts. And then once this is done, then it is implemented on the given date, or if it is recommendatory in nature, then some organizations implement well before the given timelines, right? Then for listed companies, we have SEBI LODR, SEBI regulations for the listed entities. So these works as Bible for the listed companies. Whenever SEBI issue any amendment or any new rules or regulations for the listed companies are supposed to read those timelines in a time, read those amendments, those new rules in a timely manner, assess the impact, and implement the same as per the given timelines. There is no option to deviate from those, right? Then we have NFRA body, National Financial Reporting Authority. So NFRA reviews the audit files and prepare their observations with respect to various things in the audit. Like recently, they have issued a publication in which they have highlighted serious discrepancies and lapses with respect to auditor independence, internal controls, impairment, revenue recognition, and insufficient documentation, right? Which are being considered very seriously by NAFRA and the regulatory authorities. And as a reviewer or as a preparer or as an auditor, we are supposed to be fully compliant with Ind AS and other regulatory regulations. Then we have FRRB, Financial Reporting and Review Board, which reviews the annual report of listed entities. So far, FRRB has issued 3 publications in 2021, in 2021, other in 2022, and the latest in 2025. And they have captured more than 300 non-compliances with respect to the financials. And they have published 3 detailed reports. If we want to go through the same, all these are available on the websites as well, right? So what is the key theme emerging out of all these key areas, right? Why everyone is so focused on compliances suddenly? Earlier, for last 10 years, we were into the transition phase. The companies were moving from AS to Ind AS, new amendments, new standard. But now the focus has shifted to the transparency, better compliances, and we should be comparable with the global entities when we talk about compliances, right? Second point is inadequate accounting policies. When we go through the accounting policies, there used to be significant accounting policies era, and then amendment to Ind AS 1 came, which says now the accounting policies need to be covered in the financial statement should be material accounting policies. What is material? It depends company to company, industry to industry. What is material for me may not be material for you, or vice versa. But it doesn't mean that we skip the accounting policy and we just trim the accounting policies to reduce the pages or to suit our purpose. What disclosures we are giving in the financial statement should be in line with our accounting policies. So I will take you through few observations of FRRB with respect to accounting policies as well in the next slides when we will talk about specific to Ind AS observations. Then inadequate disclosures and non-compliances with Ind AS. We are preparing financial statement. We are putting our complete efforts to prepare financial statement, preparing disclosures and everything. But when it comes to give complete disclosure in Ind AS, sometimes we miss few disclosures. For example, we need to give CV aging as per the latest requirement. But sometimes it is missed to include in the financial statements, or we need to give a complete reconciliation of effective tax rate, or a complete movement schedule of various provisions, fixed assets, and tangible assets, or disclosures with respect to impairment of assets. We will discuss all these in detail during the later part of this session, but many a times these disclosures are inadequate, and as a result of which my financials are non-compliant with Ind AS. So while we are preparing the financials as well as while we are auditing the financials, it is our duty to look into all the disclosure requirements diligently and ensure, maybe through a disclosure checklist, that all the disclosures are covered. And in today's scenario, when we are sitting, the technology has advanced too much. We are in the world of AI. Various resources are available free of cost online. ICI has issued their GPTs, right? Various third-party tools are available. So information is there at our tips. We can at any point of time check whether what note we are giving is in requirement with Ind AS or we are lacking somewhere. So the responsibility lies on us as an preparer, as an reviewer, and as an auditor, that we need to ensure all the required disclosures has been given. And if we are not giving the entire disclosure, either it is not applicable to us or it may be immaterial to disclose, which will not affect the decision of the stakeholders who will be reviewing these financials. Then we have a major area no of estimates and judgments. There are few areas in Ind AS where the management need to apply estimates and judgments. For example, valuation model for impairment or revenue recognition. In some cases, management need to apply judgment and estimates. So Ind AS requires that the applicable Ind AS requires that all judgments and all estimates has to be properly documented, and auditor need to review the same. Right, all the assumptions applied to those estimates, all judgments has to be documented. And we need to give a proper disclosure of all these estimates and judgments in our financial statements so that these can tie up with our disclosure in the financial statements. We are not missing anything, and simultaneously nothing is hidden in the financial statement. If something is missing, again, this is a non-compliance with Ind AS. Right. So this is glimpse of various non-compliances published by FRRB in their three reports. If we look at the January 2021 observation and we take two basic standards, Ind AS 1 and Ind AS 7, which governs our preparation of financial statements. In 2021, FRRB found that out of all observations, 9.2% were in non-compliances were for Ind AS 1 and 8.8% 8% were for Ind AS 7. And if we go to October 2022 report, Ind AS 1 non-compliances increased to 13%. Rather than improvement, these increased to 13% and Ind AS 7 was sitting at 6%. And if we move further to 2025 report, just 1 year back, the non-compliances for Ind AS 1 increased to 17% and for Ind AS 7 to 14%. So where we should work constantly on reducing these non-compliances, enhancing our disclosures, notes to account and financial statements quality. But somehow we are missing the relevant material disclosures in our financial statements, which are being observed by FRRB and published in their financial statement. So my advice to all my fellow professionals to do go through these observations and review your financials in line with this, whether we are missing any critical or any material disclosures, notes, accounting policies in our financial, which may lead to a non-compliance of the financial statements. Right. Let's move further to the topic. Year-end consideration for income and expense as per Ind AS. So Ind AS are governed by the conceptual framework for financial reporting, right? Any financial statement has 5 elements to it: asset, liability, income, expense, and equity. So what is an asset? Why I'm going through the basic? Because these plays a major role while deciding how an item or a transaction should be recorded in my books. If we are clear about the basic nature of any transaction, I know being chartered accountants, we are very good at recognizing the same and measuring the same. But we should be careful from the first step, whether in out of these 5 elements, where it will go, right? So we need to look at the accounting to start with from these angles. An asset is an economic resource controlled by any entity. If I am controlling any resource, be it plant and machinery, be it cash, or be it receivables or any other asset which is under my control, and I will be able to produce future economic benefits out of it. This is my asset. What is liability? Liability is my present obligation, which I need to settle by transferring the economic resources which I control as a result of past event. Like, for example, trade payables. I need to give cash or any other financial instrument to settle those trade payables, right? Then we have income. What is income? Anything which increases my equity is my income. Ultimately, balance sheet, if we look at, we have asset, we have liability, and we have equity. Equity is net asset. Total assets minus total liability is equity. Right? This is the residual interest. So whatever increases my equity, the net assets is an income to me. So when I book income, my assets increases, my liability decreases. So this is the criteria. Right? This need to be evaluated transaction by transaction, contract by contract. Right? And similarly, expense. Expense are which decreases the net assets or increase the liability or decrease the asset. Right? So that is an expense for me, other than distribution to the holders of equity holders. So this is very important to understand a transaction from this angle so that accounting is done in the right way and we can give the proper disclosure as per the respective Ind AS requirement for this. Right. So there is one more term in profit and loss statement of profit and loss as per Ind AS. The statement of profit and loss is divided into 2 parts. The statement of profit and loss, that is comprehensive income, and then we have other comprehensive income. Other comprehensive income is specifically allowed by few standards what all items to be recognized in other comprehensive income. Right. These are not recognized in your profit and loss, but they are below the line, the second part of the P&L, other comprehensive income. And this statement is also known as statement of total comprehensive income, right? So OCI are items that are not recognized in profit and loss, but directly in equity through OCI, through other comprehensive income as permitted by other Ind AS. Because from OCI, it directly routes to the equity statement. Why OCI concept is there? There are few items which are volatile in nature. For example, if I am measuring my assets or my investment at fair value, right? So fair value may change period to period because of various reasons, right? It may increase, it may decrease. So if we start taking all these gain and loss on fair valuation of my investment, of my asset to P&L, my P&L will become volatile. And the users of the financial statements, including management, will not be able to assess the business performance of the organization, of the company, right? Similarly, actuarial gains and losses as per Ind AS 19 employee benefits. So these are result of change in actuarial assumptions, nothing related to the business operations. This is why these are allowed to go into directly OCI and to equity, right? Then entities who have foreign operations and foreign operations financials, we need to convert in the holding company's reporting currency. And in the process of conversion, we generate foreign currency translation reserve, commonly known as FCTR as well. Right. The FCTR is purely because of conversion of one entity's report functional currency into the reporting currency of the holding company. So that FCTR has nothing to do with my business operations. So this is why it is being taken to OCI directly. Similarly, cash flow hedges effective portion. Whatever items are being taken to other comprehensive income has two elements further, whether it will be recycled to P&L or it will not be recycled to P&L. When we say recycled to P&L, it means for example, I am having foreign operations. If I am going to sell that foreign operation, whether the FCTR amount which I have accumulated in my OCI with respect to FCTR, so that FCTR will also be routed through P&L. It will be reclassified from FCTR reserve to P&L, statement of profit and loss, and then it will route to retained earnings in the equity, right? And when we talk about not recycled, basically these are the items where movement will happen within the statement of changes in equity. For example, revaluation surplus. If I am having a policy of revaluation of my fixed assets, so if so, there will be a revaluation reserve sitting in my statement of changes in equity and in equity bucket of my balance sheet, right? So at the time the company is selling that asset. So whatever the revaluation surplus is sitting in the revaluation reserve in my balance sheet, that will be reclassified from revaluation reserve to retained earnings directly without impacting my normal profit and loss. For taxation purpose, the calculation will be different as per tax laws. It is not going to impact my tax outgo on my gains or losses, whatever the tax position will be there. So it is only going to impact my presentation. So few items are recycled, few items are not recycled to P&L, rather directly reclassified to other elements of the statement of changes in equity, right? So OCI does not affect my current profit. Rather, it has an impact on my equity directly, because when we look at the business performance, we look at the profit after tax, right? Not at the OCI element. And in case of recyclable profits or losses to P&L, my future P&L will be impacted, but not today's P&L. So I hope I am clear till now. And this session is post lunch session. I know sometimes it is difficult to concentrate, but still I will try to keep this session interesting and in line with the practical examples so that we can actually feel it rather than only listening to it. Right now, we will move to standard by standard various observations with respect to profit and loss, and we will cover few observations of FRRB as well in this process. So the purpose of standard by standard presentation is to identify few common mistakes or few common misstatements which we know but we are missing somehow, maybe because of little ignorance, or we feel that this will not be material or this will not be cross verified with the disclosure and the accounting policies and the notes. So let's begin with India's 115 revenue from contract with customers. Right. So we used to have a India's 18 revenue, and then we got a new standard 115 revenue from contract with customer, where the standard setting authorities provided a five-step approach to recognize revenue. So this is a principle-based revenue recognition, right? So to apply the principle of recognizing revenue, we need to do a five-step check. If all those five steps are complied, only then we can recognize review and to what extent, right? So first step is identify the contract with the customer. Let's take an example of a buyer of a seller company A and a buyer company B. Buyer B approaches to company A that they want so and so goods, so and so quantity and goods to be delivered at this period or at this interval. And simultaneously they decide how the goods will be transported, whether the buyer will pick up from the warehouse or the location of the seller, or the seller required to transfer or transport the goods to the buyer, and who will bear all the risk and rewards in this process, and when the control will be transferred, right? So in this process, there has to be a contract which defines all these terms and conditions. Whether contract need to be in writing? No, there is no such condition. Contract may be oral also, but all the terms and conditions should clearly come out of that contract. So this is very, very relevant and very important to start with revenue recognition process. If we do not have a contract in place, then we do not know what all terms and conditions are there and how to recognize our revenue, right? Then step two, identify the performance obligations in the contract. The contract is there. Now the seller who is going to recognize revenue is need to identify what all performance obligations are there, right? Performance, there may be a single performance obligation, there may be different or multiple performance obligation. For example, for seller of goods, the goods may be covered under a warranty. So there will be two performance obligation. One is sale of goods, one is meeting the warranty obligations arising out of that contract. If we take example of telecom companies, right? They are selling us different plans. So those plans generally a bundle plan. They provide us internet, they provide us calling, and that to a validity of different periods, ranging from few days to a year, right? So all the performance obligations need to be identified so that the revenue can be recognized as and when any performance obligation is completed. Then step three is determine the transaction price. What is the transaction price? When I am selling goods or providing services to my customer, to my clients, I will get something as a consideration. So that consideration is nothing but my transaction price. And transaction price need not to be fixed always. It may have some variable constant. Why? It may contain some volume-based discount. It may contain some future rebates or anything, or if we comply with certain conditions, the variable consideration will increase. So transaction price is the amount of consideration an entity expects to be entitled to in exchange of goods or services they provide as promised, and it has both the elements, fixed element as well as variable element to it. But variable element to be considered only to the extent that it is probable that it will be it will be received and it will not be reversed. Why it is very much important? Because if we ignore these parameters, either we will end up with overstatement of revenue or we will end up with understatement of revenue. So revenue is always a favorite topic or favorite area of management as well as the auditors. So this is very, very critical in days where we need to assess how much revenue to be recognized at what point of time. The next step is allocate the transaction price to the performance obligations in the contract. We have identified different performance obligations. We have identified the transaction price. Now, continue with the same example. I am selling a product with a warranty period, for example, a car. car generally comes with a 2 year inbuilt warranty, 2 years, 3 years, 5 years, depending on various companies. So that warranty price is already included. I am not talking about extended warranty, which we buy separately. The inbuilt warranty, which is sold along with the car. So the consideration which we are paying has two elements to it. One is the price for the product and one is the price for the warranty. So the company, while recognizing revenue, need to allocate the transaction price to the product as a goods sold and as a service, that is warranty obligation which the company carries. So the moment we complete the performance obligation of transferring control of the goods, the company can recognize the revenue for sale of goods. But for the warranty part is the revenue need to be spread over the period of the warranty and simultaneously expense on the warranty obligation to be recognized on provision basis past experience of the organization. So we are not only deferring revenue over the period of time to which the revenue to be allocated, we are booking the expenses as well. This is our past experience. So that when revenue is recognized, the expense also hit my P&L. No warranty comes without any expense, right? And the last step, which we already discussed, recognize revenue when or as the entity satisfy the performance obligation, right? So we are good. We have transferred the goods or transferred the services. We have allocated the transaction price. Now it is time to recognize revenue, right? Now let's see common miscompliances or non-compliances, which generally are observed during the course of audit, which are generally raised by FRRBs as well, right? First is revenue recognized without transfer of control. For example, I have entered into a contract with a buyer that I will transfer the goods to the customer's warehouse and only then the control will be transferred. So the seller has manufactured the goods. These goods are lying in the warehouse of the seller and they have informed the buyer that the goods are ready to dispatch, right? But the marketing department in hurry to recognize our revenue for various reasons, they pushed the finance team to book the revenue. But no, the revenue cannot be booked because as per contract, it is my duty, it is seller's responsibility to transfer the goods, to transport the goods till the location of the buyer. Only then control will be transferred. Otherwise, all the risk is lying with the seller. If something happens to the goods in the warehouse or in the during the course of transport, the all the risk is lying with the seller. They cannot recognize revenue until the goods are transferred to the buyer's location and accepted by them, right? Then we have incorrect identification of performance obligations and transaction price. As we discussed earlier during 5 steps approach, performance obligations need to be identified while analyzing the contract. Let's continue the case of warranty obligation. Can I recognize the revenue of warranty obligation which is spread over 2 years upfront? The answer is no. I need to recognize that revenue over the period of 2 years, and I can recognize revenue every month, every period at basis my obligations of warranty along with the corresponding cost. Similarly, transaction price. One more issue is here whether the revenue to be booked at the fair value or at the transaction price. So the revenue is booked at the transaction price. Fair value comes into the picture in case of exchange. How to identify the value, what we are receiving in exchange, right? Otherwise, it is a transaction price, it is not a fair value. So this is general misconception that revenue is to be recognized at transaction price. No, revenue is to be recognized revenue is to be recognized at transaction price and not at fair value. Many a times, variable consideration is either ignored or those variable considerations are also considered which are less probable to happen or there are high chances that this will be reversed. For example, volume-based discount, right? Today, we know that the particular buyer basis the past experience will cross the threshold to get the volume-based discount. But In a hurry to recognize higher revenue, we ignore that we need to provide volume discounts as well, right? Or vice versa, we understate our revenue, even ignoring our past experience, and we recognize less revenue, right? Then significant financing component. What is significant financing component? For example, there is a company which manufacture and provides machinery on order, right? And general credit period the seller provides is 3 to 6 months, depending on the customer, depending on the credit rating of the customer and various parameters they have in place. The seller has entered into a contract with a buyer to provide machines worth 10 crore over a and the credit period as per the contract is 1 year. The machine will be delivered in 3 months, but the credit period allowed to the buyer is of 1 year as against the policy of credit period of 3 to 6 months. So can we say that this is the transaction price which for which I can recognize the revenue upfront upon transfer of control? No, we need to deep dive into this contract. First indicator is when my general credit period is 3 to 6 months, then why for this particular customer a 12 months credit period is allowed, right? Whether we are providing a financing arrangement with that customer, means we are providing extended credit terms, are we earning something in form of finance income from that customer? We see at the transaction price, the same machinery we are selling to other customers with the 3 to 6 months of credit period for let's say 9.5 crore. But for this particular customer, we are selling for 10 crores. So this is 50 lakhs extra for an additional credit period. It means this contract has a inbuilt financing arrangement, which is not apparent from first reading of the contract, but when we deep dive into it, we read between the lines, this is a financing arrangement. The buyer could have taken borrowings to pay us, but rather we entered into a contract and we are providing financing arrangement as well. So we need to allocate the contract into two elements, upfront sale as well as the financing part to it. We need to allocate the transaction price to the revenue from sale of goods and the financing income, and in profit and loss, we need to book both the income separately. So the sale of goods income will be recognized upfront, whereas the financing income will be recognized as a finance income over the period of the credit period, right? Then one more interesting issue is gross versus net presentation errors, principal versus agent. What is a principal and what is an agent? Generally, a principal is who bears the inventory risk. I am manufacturer of goods. Or let's take example of a travel agent, travel portal, any travel portal you take. They are selling travel tickets, but they are not operating airlines. They buy inventory from third parties or directly from the airlines, and they are selling to their customers using their platform. Do they bear the inventory risk? No. Inventory risk is lying with the airline. If the tickets are unsold, the online travel portal is not going to bear any loss. They will earn commission only on the tickets which are sold through their platform, right? As against to it, if for example Indigo Airlines is also selling tickets on its website, right? So here Indigo is principal to this contract because they have the inventory of the air tickets. They are selling it. If the inventory is unsold, the seats will be vacant at the time of flight. So they will not, they will be responsible for that loss, not the online travel portal, right? So the travel portals mention in their accounting policies that they are acting as an agent to the airlines and they do not carry the inventory. So they are recognizing revenue on a net basis and they give a complete movement schedule or a disclosure of this. How much is the gross revenue? How much is the gross ticket price? And out of which, how much is the commission, which is their revenue? In the same example, if we talk about hotels or talk about holiday packages, the travel agents also sell holiday packages, right? In which air ticket, logistics, hotels, transport, visa, everything is included, right? So in this case, many travel companies recognize the revenue as a principal. They say we bear the entire risk until so they bear the risk, right? At the time of check-in, they should be able to fly until and unless the airline has cancelled the flight. But they bear the risk. If the flight is cancelled, they will provide an alternative to the customer, to their client. And when the moment they reach to the hotel, the hotel which is booked by the client, by the customer, that hotel should provide check-in to that customer. So they carry entire risk with them, right? So in those cases, they book the entire revenue as their revenue, and whatever they are paying to the airlines, to the hotels, that is recognized as cost. So within the same organization, we have different presentation, different recognition criteria depending on the nature of the transaction, how management looks at it, how this is the transaction is structured. So we need to be very, very careful while we are recognizing the revenue, right? Then we have contract assets and contract liabilities in place, right? We have manufactured the goods are delivered to the customer, but billing is not done. Can I book the trade receivables? No. Without billing, I cannot book trade receivables. There is a thin line between contract assets and trade receivables. Trade receivables, in case of trade receivable, the company has unconditional right to receive the money, and the only element is passage of time. There may be a credit period to it, right? So only passage of time is remaining, the money will be received. But in case of contract asset, the company has delivered the goods, but the billing is not done. So my revenue, sorry, my recovery is dependent on fulfillment of certain conditions. So I need to book contract assets. And contract liabilities, basically when we receive advances from customers against delivery of goods. So we need to book contract liabilities. And Ind AS 15 requires a complete disclosure of these contract assets, contract liabilities, how much, why I am booking a contract asset or a contract liability, what was my opening balance, what is my closing balance, what is the movement between, and what are the remaining performance obligations yet to be completed for those contract assets and contract liabilities. Generally, what happens, we give disclosure of contract asset and contract liabilities, but we miss disclosure of performance conditions yet to be fulfilled. So in that case, it becomes a non-compliant Ind AS financials with respect to Ind AS 115. Further, there are various disclosures required by this standard. We need to disaggregate the revenue depending on the revenue streams we have, geographical locations, right? And remaining performance obligations, again, judgments used in in deciding the revenue and the performance obligation. So complete disclosures are need to be given without any exception to it, right? So missing disaggregation or missing the judgment used results into a non-compliance. Then we have inadequate accounting policies. Many a times we say in our accounting policies that revenue is recognized when the payment is received. No, we follow accrual basis of accounting, not payment basis of accounting. If we are writing in our accounting policy, revenue is recognized on payment basis, that is a gross non-compliance with Ind AS 115 with the basic theme of accrual basis of accounting, right? Similarly, we need to give various reconciliations. Right? We talked about variable, consider variable constant. So we need to give a gross contract price and the revenue recognized. So we need to give a reconciliation what all the elements have changed my revenue recognized in my books, which may be discount, rebate, refunds, credit, etc. So there is a complete reconciliation which we need to give, right? So we need to deep dive into all the contracts, how I am recognizing revenue. I may be doing everything right, but certain disclosures are not given, which result into non-compliance of Ind AS. So if we need to summarize, Ind AS 15 is a hotspot for auditors. They start with the top line and evaluate each and every transactions based on materiality and identify misstatement of revenue, understatement of revenue. And this is the also area where the management or the CFO gets surprises at year end. Oh, this revenue should have not been recognized, or our financials are overstated with this much of revenue. So we need to be very careful about this standard. Right, let's move to the next standard, Ind AS 116, leases. This standard was also issued 6, 7 years back, 7, 8 years back rather, and it replaced the existing standard 17 leases, and now there's a new standard, Ind AS 116, which completely change how a balance sheet looks like. So this is not just an accounting change, but a balance sheet plus EBITDA story. There used to be a rent lying in my P&L for all the leased assets, right? But that changed to depreciation and interest on account of recognizing ROU assets and the lease liability corresponding to it. In case of lease, we need to evaluate whether that contract contains a lease and we should recognize ROU asset and the corresponding lease liability to it, right? So what is so quickly, I will take three conditions which I need to evaluate or we need to evaluate by identifying whether a contract contains a lease. This is right to control the identified asset. So keywords are control and identified asset, obtain economic benefits out of it, and right to direct use of it, right? If these three conditions are satisfied, if these three conditions are satisfied, then we can say there is a right, we need to recognize the right of use asset and corresponding, we need to recognize a lease liability, right? So when we recognize an ROU asset, it sits in as ROU asset in my balance sheet, and we need to depreciate my ROU asset. Earlier we used to recognize rent, but now we need to depreciate the ROU asset. And depreciation has to be on a systematic basis over the lease term. So the lease term assessment is a critical judgment area. If we talk about presentation and disclosure and recognition in my financials, what is a lease term? Lease term is generally a non-cancelable period in my lease agreement, as well as any, we need to give due consideration to the extension and termination options, if reasonably certain. So that may form part or may not form part of the lease term. So we should give due consideration while identifying lease term, and then only we can recognize at what well we can measure my ROU asset and the corresponding lease liability. So which will in turn impact my recognition of depreciation over the lease term on a systematic basis, as well as the interest on the lease liability. In case of lease liability, there is a lease liability at the time of recognition based on measurement principle. Then we need to accrue interest on it. It gets reduced by the payment made during the period, and then we have a closing period. So this is also a disclosure in my financials, the complete disclosure of movement of ROU asset as well as lease liability. So we need only to assess, we need to give the proper disclosures, and there is an accounting policy as well in my financial material accounting policies with respect to lease assessment. Right, we need to give material information which is relevant to all the disclosures made in the financial statements. Right. With the leases, my EBITDA improves as I told earlier, but my cash flows remain same. I need to pay to the vendor. I would have paid in the erstwhile in day 17 leases as well. It does not change my cash flow, but it changed my P&L presentation. So perception changes with respect to EBITDA. EBITDA is very, very important performance measure, which is reviewed not only by the management, but by the various investors and other stakeholders as well. Right. So depreciation we discussed. Sometimes incorrect recognition of interest happens and derecognition of ROU asset happens. In case of interest, one more interesting point is when we discount the lease payments to arrive at the ROU asset and the corresponding liability, we use a discount rate to arrive at the present value. So we need to unwind the interest on my lease liability at the same discount rate which was used to discount the lease payments to arrive at the ROU asset and lease liability. If this discount rate is changed, sometimes what happens, the discount rate change in the market. So in a few cases which I have seen, the interest accretion rate is also changed without any change in the underlying agreement. This is incorrect. I need to use the same discount rate until and unless there is a modification to the lease. The discount rate can only be changed only in case of modification to the lease. If in between we are changing the discount rate, this is a gross non-compliance with Ind AS. My P&L will not give a correct picture of my expenses, my lease liability as well, right? So discount rate cannot be changed until and unless there is a change in there is a modification to the contract, right? One more thing, variable lease payments. Sometimes what happens, if we are if someone is going to take a space on lease in a mall or at the airport, so apart from the fixed lease payment, there is a variable component to it. Variable component generally happens in two ways. One is a percentage of revenue, means let's say the monthly rent of a retail space is 10 lakhs per month plus 10% of gross revenue, whatever that store books. Or the other way of variable lease payment is 10 lakhs revenue per 10 lakhs of rent per month plus the variable lease payment is linked to a index or a rate. For example, inflation rate or a CPI index. See, whatever will be the index at the month at the year end, basis that percentage of the total rent will be charged as additional rent, right? So Ind AS 116 provides very clear guidance that in case of variable lease payments, when these are based on certain index or rate, like inflation rate, CPI index, these form part of my calculation of ROU asset and lease liability. Whereas this is dependent on certain percentage of revenue or some other criteria that cannot be measured today, and those are ignored for the purpose of calculation of ROU assets and corresponding lease liability. And these payments are made as and when we recognize the revenue, we calculate certain percentage as per the agreement terms, and we pay, and the expenses is booked. Right? Then there are two exceptions, two exemptions provided by Ind AS 116, short-term lease and low-value exemption. Generally, these exemptions are misused by the corporates. What is a short-term lease? Short-term lease is a lease having a lease period of 12 months or less, right? Only then it qualifies for a short-term lease exemption. Also, if there is an option to purchase that asset in the lease agreement, then this short-term lease exemption cannot be availed, right? We are out of the exemption criteria for short-term leases. Then we have low value exemption. Low value exemption criteria is not defined in Ind AS. What is low value? This is again management judgment based on the nature of industry they are working in, nature of asset they take on lease. What should classify for low value exemption, right? But certain companies have any asset taken on lease below 5,000 rupees will classify as low value exemption, right? For example, a company takes chair and table for office desk on lease, and individual value of set of chair and table is only 4,000 rupees. Then it will classify as low value lease. And now whether company takes one desk or 100 desks. So 100 desks together will also classify for low value lease. We cannot say 100 into 4,000 will be 4 lakh. So it will be out of the low value exemption. No, it will be covered in low value exemption, and this is seen item by item, right? One more nitty-gritty in this is, for example, a company which is taking cars on lease, right? And depending on the industry, nature of the industry, they classify that any value below 5 lakh, any lease taken below 4 lakh rupees will be classified as low value lease. So now they have taken a Mercedes on rent, Mercedes on lease. The Mercedes is old and the monthly rental is only 3 lakhs. But the standard says, the guidance says, you need to look at the value of the asset you are taking as if it is new asset, not the second hand or the old asset. If that model of Mercedes in the market, new model is worth 50 lakhs, but I am taking it as a 3 lakh rupees rental. So I need to look at the 50 lakh rupees. So which is well above my low value exemption limit which the company has set up in the company, right? So the low value exemption will not be available, right? So if you look at India's 116, it improves my EBITDA total expense which I recognize during the initial period of lease are front loaded, because when I recognize ROU asset and when I recognize lease liability, so the interest on lease liability will be higher, whereas the depreciation will be same over the period of lease, but interest initially will be higher and it will decrease gradually with the lease payment. So total lease expense recognized decreases over the life, but it is front loaded in the initial period of lease. Hope I am not running too fast. My pace is right. So let's move to the next Ind AS 23, borrowing cost. Very interesting topic. What is borrowing cost? Borrowing cost is something which I am spending for borrowing funds. It includes interest and other costs as well, right? What are the other costs? Maybe, for example, when we take a borrowing from a bank, they charge certain percentage of that borrowing amount as processing fee, which ranges from certain points to 2%, 3%, 4% also. It is a huge chunk, right? And there is a concept of effective interest rate in Ind AS 109. We need to calculate effective interest rate to include not only the interest as well as other cost element which classify as a borrowing cost, so that my P&L can spread the upfront fee which I have paid as a borrowing cost to the lender over the period of the borrowing, and my P&L is not loaded with the cost upfront which is being paid upfrontly, right? So borrowing cost, we know this is interest and other costs calculated on the basis of effective interest rate. But why borrowing cost is so important? If a company is constructing any asset, right, they use borrowings to construct that asset, they spend interest and other costs, that is borrowing cost on those borrowings. So the Ind AS 23 permits to capitalize those borrowing costs which are directly attributable to the qualifying asset, right? For example, a company is constructing a factory which will take around 1 year to complete. It purchased land, it borrowed money and purchased land, and then it borrowed money to construct the factory on it. So now there are two types of borrowing. One for the purchase of land, and second for the construction of facility for the factory, which will take 1 year to complete. Right. So generally, we capitalize borrowing cost on qualifying assets. What is a qualifying asset? Which takes substantial period of time to construct, to acquire, or production. So these are qualifying assets, right? Factory is going to take 1 year. I took borrowing for the acquisition of land, but the standard says the borrowing cost incurred towards acquisition of land does not cannot be attributed to a qualifying asset, because land as it is usable. You are constructing a factory, that is a separate issue. but the land which you purchased is usable as it is, and the borrowing cost you are incurring on that land cannot be capitalized because the land is not a qualifying asset from the perspective of Ind AS 23 for qualification. Some entities capitalize the interest on the borrowing cost on acquisition of land as well, which is not in compliance with Ind AS. Then whatever borrowing cost I am incurring on construction of factory only can be capitalized. In this, we have two concepts, specific borrowings and general borrowings, right? If I have taken a specific borrowing for construction of factory, then I know the specific borrowing cost attributable to that factory. However, let's say a company has limit of 100 crores, out of which 25 crores is being used for construction of factory. So they need to calculate the weighted average capitalization rate for general borrowings, which can be attributed to that qualifying asset where 25 crore borrowing is being used, right? So substantial period of time differs industry to industry, right? General condition is substantial period of time, right? If we are constructing a building, a plant, right? So the substantial period may run into months, may run into years. What about telecom industry? Telecom industry spends thousands of crores to buy spectrum, and that spectrum, when bought, is ready to use. Generally, it is ready to use. It just need to be deployed on the system so that it can be actually used, right? Which is generally there is generally a gap of few days, not months, not years. There is generally a gap of few days because a telecom company which is spending thousands of crores to buy a spectrum, they prepare in advance. All the systems are in place. They just need a specific time period to deploy the system, to deploy the spectrum on that system, and it is available for use, right? So in case of telecom companies for spectrum, the qualifying period is only few days, as against the general perception, which takes long or substantial period of time, right? Then there are suspension of capitalization and cessation of capitalization, right? For example, we are constructing a factory and it will be completed in 6 months, but due to strike, my active development is stopped and that strike runs for 1 month. But I am incurring borrowing cost on that for that period. Can I capitalize that borrowing cost for that period? No, because in that case, the active development was not happening at all. This is a temporary suspension of capitalization. So for that period, the borrowing cost should be charged to P&L rather than to be capitalized on the asset being constructed, right? In some scenarios, suspension may be there, but my active development is not stopped. For example, I am constructing a large dam, a large bridge or a large dam. So there is a lot of technical and administrative work also to be done in between to complete the project, right? Which is essential to the contract for the for construction of bridge or the dam, which is essential it, right? So let's say it out of the 2 years period of time, 3 months in between goes for technology, technology work and administration work. So for that 3 months, we cannot say that active construction was not there. We cannot see the bricks moving, but the technological work, the administrative work was happening, and post completion of which the active construction again will start. But my active development was in place. So the suspension will not happen for borrowing of capitalization cost. The borrowing cost will be capitalized, right? Then we have cessation of capitalization, capitalization of borrowing cost, right? When cessation happens, for example, I am constructing an asset. The construction is already complete. The only thing is the inauguration is not done, right? But the plant which is constructed, it is ready to produce goods which are intended to be sold in the market. There is no further active development to be done. So the point, it is ready for the asset is ready for the intended use. The capitalization of borrowing cost has to be stopped. The remaining borrowing cost will be charged to profit and loss, right? Then in case of foreign currency borrowings, there is a certain extent to which the forex difference can be capitalized, but not the entire forex loss which can be capitalized. This is generally a difference of the interest rate in the home market of the borrower and the loss extent, the difference of which is capitalized, right? Then if we come to the disclosures, we need to provide complete disclosure. In many cases, disclosures are insufficient. The management has given or done everything right as per Ind AS 23, but disclosures are insufficient. For example, out of the total borrowing cost, we need to specify how much is capitalized and how much is charged to P&L. There is a reconciliation given. If that reconciliation, that information, the disclosure is missing in the financial statements, then my Ind AS are non-compliant. Then my financials are non-compliant, right? Then one more interesting Ind AS 36 impairment, right? In AS 36, which talks about impairment. Impairment is basically the difference between carrying amount of an asset and recoverable amount of an asset. What is carrying amount? Carrying amount is the amount at which any asset is being shown in my financials, right? The depreciated value of any asset. In case of power plants, in case of highways, right? In case of large plants, generally we see the impairment issues. Just a minute, please. Right. So for testing impairment, generally there are few indicators with respect to internal indicators, external indicators. For example, I have a plant and machinery which has become obsolete due to technological advancement, or it is not able to produce the goods at the pace it is supposed to. The future economic benefit that I will receive from using that machine has reduced drastically because of various reasons. That technology has become obsolete, the capacity of the plant has gone down because of various reasons. So a management need to keep an eye on all the triggers, all the indicators, be it internal indicator or external indicator, and to do a impairment testing of all assets if any indicator exists. Impairment testing is done mandatorily if there is any trigger. However, in case of goodwill and in case of indefinite life intangibles, mandatory annual testing has to be done. This is prescribed by the standard. In many cases, we miss this point. I have seen in my practical exposure, we miss this point that goodwill and intangible life assets are not testing for impairment annually, and this result in audit issues as well as non-compliance with the Ind AS, right? And whenever indicator exists, the management do a impairment assessment. Then impairment loss need to be recognized in the financial, right? And after a detailed impairment uh, impairment test, the impairment loss need to be recognized in the financials, right? We know recoverable amount is higher of value in use and fair value less cost to sell. What is value in use? If this is a plant and machinery, or this is a highway, or this is a power plant, we see how much revenue we can generate over the life of the plant or 5 years plus terminal value of that asset. We prepare a financial model around that using certain assumptions, discount rate, and everything, and we arrive at the cash flows, present value of cash flows, which is known as my value in use, right? So the judgment areas in these are discount rate, growth rate, terminal rate, cash flow projections. In case of power plant, the capacity of the power plant at which it will be used over the life. In case of highway, it is vehicles, projections with respect to vehicles that will cross that toll plaza, right? So there are various judgment used, and for each and every judgment, management need to document it, right? There are several agencies in the market which do research with with respect to if we talk about highways, how much traffic will be passed through that highway, and that study is used as a basis for the revenue projections. Then growth rate depends on various factors. If it pertains to highway, again, the sale of cars, sale of vehicles, right? The nearby construction, which will give benefit to the usage of highway and various other projections, which are various other parameters which are being used for development of that model. So when an organization develops a model to be used for the purpose of impairment testing, right? So whether impairment is there or impairment is not there, but the impairment triggers are there, that model has to be developed, and to the satisfaction of the auditors, that why there is no impairment, or if impairment is there, then how much is the impairment, right? And when we provide disclosures in our financial statements, we need to provide complete disclosures with respect to what assumptions we have used, be it discount rate, be it growth rate, be it cash flow projections, what is the terminal rate is used, and as well as we need to give us sensitivity analysis. For example, we have used a discount rate of 15%. What will happen if my discount rate decreases to 14% or increases to 16%, right? So that sensitivity also need to be given in the financial statement. The sensitivity is already part of the valuation report as per the Ind AS requirements, as per the IFRS requirements, accounting requirements. This is already a part of my valuation report because valuers also work in line with Ind AS requirement. They follow Ind AS 13 for fair valuation, right? So everything is giving, they know what all disclosures are required, but we need to give the right disclosure in the financial statements as well, right? And when the conditions improve, impairment loss may be reversed as well, and which is accounted in the books. But sometimes what happens, and out of ignorance, the reversal of impairment is not considered in the books. Whereas the standard says, with respect to goodwill, impairment loss cannot be reversed, but with respect to other asset, if the condition improves to a satisfaction, and it is apparent from all the calculation, then it can be reversed and again can be booked in my financial, right? Then disclosures we discussed, all assumptions with respect to financial models, which method is used, how we have arrived to that value. Everything has to be disclosed to give a correct disclosure in the financial statements, right? If if anything is missed, right, we provide certain projections at the beginning of the year or at the previous year. We did a detailed impairment as a study, and we said no, only this much of impairment or no impairment. But at the next year end, we need to justify actual results with the projected result. If there is any movement, if there is any gap, the desired results are less than the projections, right? The entire model needs to be overhauled, which may result into a higher impairment, right? So which may give surprises at the year end. So deep, we need to review these projections during the year as well, so that the right course of action can be taken during the period when the management has time, when the performance can be improved or the remedies can be implemented, right? Then let's move to a next standard, Ind AS 38, intangible assets. So the name of the standard is intangible asset, but it covers research and development as well, right? So there are various kind of intangible assets when we talk about intangible assets. But as per the standard, we cannot recognize internally generated intangible assets in my books. What are those assets? Like goodwill, the brand value, the customer list. These are few assets which an entity has developed over the course of time because of the good products, good services, after sale services, behavior, and everything. But these assets cannot be recognized in the books. these assets cannot be capitalized. So we need to be very sure. Only acquired goodwill or goodwill out of business combination can be recognized in books. Similarly, for brand value, for customer list, everything. Internally generated assets cannot be recognized. So this is also an area where we have seen various non-compliances. Now let's talk about R&D, research and development. So whenever any new product is developed, so there are two phases to it: capitalization phase, sorry, research phase and development phase. So whenever a company starts any research, the standard is very clear. During the research phase, this is specifically applicable to pharma companies. They keep researching various medicines for various diseases, right? They spend lakhs of crores of money on only research activities. Few research enter into development phase, and as against it, few research and at the research phase only. So standard says, IAS Ind AS 30 says that only research expenses cannot be capitalized until it's moved to the development phase. Means research phase has to be expensed out. Only when it enters into the development phase, only those expenditures can be capitalized. This is the giving criteria. What is the giving criteria is there should be a technical feasibility. If we are entering into a development phase, we have to justify that yes, technical feasibility is there, technology is there through which this medicine, if we are take example of pharma, these medicines can be developed. Then management has intention to develop and they have ability also. For example, if that development is going to take a huge amount of money or huge efforts in terms of manpower, whether the management has intention to deploy that amount of money, deploy that manpower to complete that. If yes, then it can be capitalized. And then next is future economic benefit, because accounting, whenever we talk about accounting, we talk about future economic benefits, right? You are capitalizing something, and this will be an asset. An asset should result into future economic benefit. So once this development is complete, whether we will be able to generate future economic benefits out of it, if these conditions are met, only then we can recognize. So generally, what happens? Management is very aggressive. They don't want to hit P&L for each and every expense because of the sake of EBITDA profitability, and they try to capitalize the expenses to the extent possible. But when it comes to assessment of these three conditions, somewhere the conditions are not met, right? So as a result of which, whatever was not parked to the P&L during the year is comes back to the P&L at the end of the year, which is a surprising shock for the management, right? So documentation is very essential for all these three conditions, so that same can be shown to the auditors as well, and there are no last minute surprises, right? And one more thing in this, once an expense is charged to the P&L, for example, in a listed company, quarterly results are published. In one quarter, certain expenses charged to the P&L. Then in next quarter, same expenses cannot be written back and cannot be capitalized. Once charged, then it is charged. We cannot reverse from the P&L and move to the balance sheet. So this is also a specific area where many non-compliances happens, right? So in Ind AS 38, sorry, one more thing, amortization of intangible assets, assets with finite life, for example, trademark or acquired tangible assets, which have finite life are amortized over useful life. So our useful life assessment is done over which the amortization is done on a systematic basis, which is generally straight line basis. And assets with indefinite life, for example, goodwill. If we are saying goodwill has indefinite life, or if we are saying the brand which is acquired has indefinite life, the management believes that we will get the benefit for indefinite life. Then every year, right? Every year, impairment testing has to be done, and this is to be justified and documented, and also disclosed in the financial that management has done impairment testing, and because of so and so reasons, there are no impairment triggers if if no impairment loss is recognized. So disclosure requirements are again useful life, disclosures, amortization method, reconciliation of carrying amounts, opening, capitalized, amortized, sold, closing value. So all those disclosures need to be presented. So India 38 is a key driver of profit timing. What gets capitalized today is depreciated over the useful life when the depreciation starts, or it may result into impairment also. So we need to be careful what we are capitalizing. And similarly, we have India 16, property, plant and equipment, which also talks about capitalization of not only purchase cost, but also the directly attributable expenses, right? So generally, a critical judgment area where we need to provide, where we need to use our judgment area, what to be capitalized, what not to be capitalized, and the relevant disclosures are given in the financials, which generally become a debatable point during audit as well as may result into non-compliance because of incomplete disclosures about judgments. Then component accounting for airlines for aviation companies. This is very important because engine has different useful life, the body has different useful life. Similarly, for various machines, componentization to be done. But in real life, what happens? Management takes a single useful life for the entire asset rather than doing the componentization. Whereas it is beneficial to the management. Some major parts have higher useful life, some parts have less useful life. So the depreciation can be charged over different useful life. But if this is missed, then we have to charge depreciation over the useful life at the same rate. Right? In this assessment, we need to assess what will be the useful life and residual value. Right? So we need to put estimates, we need to use judgments, technical experts we need to use to decide what will be the useful life on asset and what could be the residual value, right? And this need to be reviewed at each year. And in our financials, we mention in our accounting policy that useful life and residual value is actually reviewed at each year end. But if something is being reviewed, then do we have audit committee minutes for this, whether it was presented to the audit committee? So in many cases, the company forgets to document it through audit committee meetings that how these reviews were done, what is the outcome of those reviews, and that is reviewed by the audit committee as well, right? Then non-recognition of decommissioning liabilities. For example, a company is establishing or constructing a power plant in a good 50 acres of land that has a 30 years of life. And as per the lease agreement of that land, the company need to restore the land in the position it got. Means everything has to be removed after 30 years, right? So asset retirement obligations are there. So company need to estimate what will be the amount of asset retirement obligation after 30 years of life, discount it to the present value using the discount rate, and capitalize that ARO, asset retirement obligation, to the value of the asset. So with this, my depreciation will be higher. Once the asset is capitalized, my depreciation will be higher on account of ARO. Simultaneously, on account of ARO obligations, there will be interest cost hitting because I will be unwinding the present value of asset retirement obligation to the future value with each passage of time, right? So my interest cost will hit my P&L. But generally, organizations ignore this aspect. ARO is not calculated or not capitalized, or interest part is missed, right? Then disclosures, again, complete movement of fixed assets. Then capital work in progress, aging. I discussed it during opening of the session. And corresponding one more issue is capitalization of spare parts. Some spare parts are eligible for capitalization, and some spare parts are not eligible for capitalization, should be expense. So there is non-compliance because of this. So common audit issues we face: over capitalization of expenses, delayed depreciation start, means asset is ready, but we are not We have not started appreciating the same. And inconsistent useful life over for the same asset, means for the same class of asset, inconsistent useful life is being used, right? Let's move to the next standard, Ind AS 19 employee benefits. So looks difficult because of a lot of disclosures, because of actuarial reports and everything, lot of movement schedules and everything. But this is very, very important, right? If I talk briefly about this, employee benefits are categorized into four parts: short-term employee benefits, post-employee benefits, other long-term employment benefits, and the termination benefits. Out of these, there is a most critical is post-employment benefit, which is divided into two parts: uh, defined contribution plan and defined obligations, defined benefit plans. So defined contribution plans are like PF, right? The company deduct PF from salary, add their contribution and contribute to the EPFO, right? So the obligation of organization is limited to the contribution being made to the EPFO. If at the time of retirement or termination, the actual amount is more or less, the organization is not responsible for the same. The EPFO has to pay the complete amount to the employee who is exiting out of that fund, right? So that is why it is called a defined contribution plan. But as again, defined benefit plan, organization is responsible to make good for any deficiency in the plan. Means whatever the amount is agreed that it will be paid at the time of retirement or termination. If there is a shortfall, even after making regular contribution, maybe due to change in discount rate, that is actually assumptions, retirement age, demographic factors, and various other factors, then company make good of those shortfall and contribute additional amount to the fund. In this case, a very interesting FRRB observation is there. FRRB has found that though the company in the disclosure has mentioned PF fund contribution as a defined contribution fund, but in the disclosure, in the theory part of the disclosure, they are writing that they are responsible for contributing additional amount in case of any deficiency. So this is contradictory. One side we are saying this is a defined contribution plan, and in the theory part of it in the disclosure, we are saying the company is responsible for making good the losses, making good the deficiencies. So FRRB said this is a gross non-income non-compliance with the Ind AS 19. Also, one more thing, constructive obligation. Like what is constructive obligation? Constructive obligation is something which is coming out of my behavior, my actions, but not written anywhere. For example, in case of contribution to the funds, in past an organization has contributed whatever the deficiencies in the funds have taken place, but this is not written anywhere, right? So this is a general expectation in the mind of the organization, the people working with the organization, that if in future, if there is any inadequacy or any deficiency in the funds, the organization, as did in past, will make good for those efficiencies as well. So that calls for a constructive obligation, and in future, the management cannot say no because there is a constructive obligation basis the past actions, right? So though this is standard is very detailed, but I have covered in the in a short way what non-compliances may be there. We need to disclose all the actuarial assumptions as provided in the actuarial report, discount rate, salary growth, attrition, mortality. One more thing, actuarial valuation need to be done only in case of defined benefit plans, not in case of defined contribution plans or other categories like short-term benefit, other long-term benefits, or the termination benefits. Right? And the actuarial gains and loss goes and sit in my OCI part, not in the P&L part. So there may be discrepancies in disclosure with respect to components of employee costs are not disclosed properly, provision movements are not disclosed properly, or the actuarial assumptions are not disclosed properly. This is all about employment benefits. Then let's have a time check. Rahul, we can continue for 5-10 minutes more with respect to few Indias more.
Yeah, sure, sir. You can continue.
Thank you, Rahul. Right. So next is deferred tax. During initial phase of my career, deferred tax used to be very simple in the AS scenario, right? It used to be very simple, and generally we studied and we calculated deferred tax, asset, deferred tax liability. But with the introduction of Ind AS, this has become a most complicated, one of the most complicated area. The concept of temporary timing difference, deductible temporary difference, tax base, book base, balance sheet approach, and everything. Right? It has become a complex area, but if we look at the basic concept, it more and less remains the same, right? The which we used to call timing difference are now known as temporary taxable temporary differences and deductible temporary differences, right? Taxable in case of taxable TTD, taxable temporary differences means the items which will be taxable in future means my tax liability is deferred to the future. So I should recognize a deferred tax liability today, right? And in case of deductible temporary differences, means I will get tax benefit in future. This is deferred for now. I should recognize deferred tax asset if future taxable profits are probable. Then only I can recognize deferred tax asset, right? Why this concept? So that my current tax, whatever the tax, my tax expense being shown in my profit and loss shows the correct picture. It is not inflated or deflated today, and rather not overstated or understated today, and the impact which will come in the future. So this standard was issued to curb this discrepancy with respect to tax expenses, right? So in case of recognition of deferred tax, we need to be mindful that deferred tax asset can be recognized only if future taxable profits are probable. In AS, there was a different language, convincing evidence and everything, but now it is probable. If it is probable, only then I can recognize a deferred tax, right? Then whatever deferred tax asset and liabilities we are having in our balance sheet should be reviewed at each reporting date. If it is quarter end, then it should be reviewed at each reporting date with respect to whether the DTL I am carrying is sufficient or I need to recognize more. Is there any change in the tax rate, or whether the DTA I am carrying in my books, whether I am still, it is sure that I will earn, the entity will earn future taxable profits are still probable. If there is any change in the underlying calculations estimates, the calculation, the recognition, the measurement has to be done again. Then one more basic principle to this is deferred tax is recognized in the same part of the P&L or the balance sheet where the base item is lying. For example, if I've recognized fair valuation gain or loss, revaluation gain or loss of PPE in OCI, then the deferred tax element of that fair valuation gain or loss should be recognized, but has to be recognized in OCI only. It cannot come and sit in the first part, statement of profit and loss, right? Similarly, if something is recognized directly in equity, the deferred tax part will go and sit directly in equity. And for the remaining items which are recognized in P&L, the deferred tax impact of the same will be recognized in the P&L part, in the part one, right? So while recognizing DTA or DTL, this we have to be very mindful of this. Otherwise, again, we will end up in the non-compliances, right? And then most importantly, we need to give the proper reconciliation of tax expense and tax expense with accounting profit, effective tax rate as well. Right? Many companies miss these disclosures or the disclosures are not complete, result into non-compliances. Right? Then quickly move to Ind AS 21. In case of foreign exchange, if an entity is operating in India and has transactions in a foreign country, that foreign currency transactions are recorded at the spot rate on the date of transaction. But if a company is having a foreign operations, right? So for the purpose of consolidation and reporting, those foreign operations need to be translated into the reporting currency of the holding entity, that is INR in this example, right? If the financials of that foreign operations are in USD, so these need to be translated into INR using the closing rate for asset and liability, average rate for income expense, historical rates for equity. And in this conversion process, there will be a difference in my balance sheet, which will be a FCTR, foreign currency translation reserve. So FCTR never goes into P&L, it goes into OCI. This this is a clear guidance from India. We saw it in the initial slide as well. Whereas the exchange movement on the transaction recognized in the Indian entity financials, when they are restated, when the asset and liabilities are restated at the closing exchange rate at the period end, those exchange differences are recognized in profit and loss in statement of profit and loss. Those hit my P and L, right? Those are not recognized in OCI. So Ind AS 37 provisions, contingent liabilities, and contingent assets. Provision is something which arise out of my present obligation, but the amount is not certain. There is certain uncertainty in, so we need to apply reasonable estimation, right? So those estimation need to be disclosed. Those judgment needs to be disclosed in the financials. Then for contingent liabilities, right? Sometimes what happens, we need to create provisions, but rather we end up showing it as a contingent liability because for contingent liability, there is no provision in my books. It does not hit my profit and loss. Or vice versa. Some item qualify for recognition of contingent liability, but we end up recognizing a provision. So this may result in overstatement as well as understatement of my financials. Onerous contracts. If any contract where unavoidable cost of completing the contracts are more than my expected benefits. So this need to be evaluated on contract by contract basis. And if we have any onerous contract, so we need to create a provision for all the expected future losses as well. Generally, these provisions are not discounted, but if the time value of money is material, for example, asset retirement obligations, in case of a power plant, asset retirement will happen after 30 years, right? So time value of money is very, very material in this case. So we need to discount those provisions. As against profit, when we talk about Ind AS 12 income taxes, deferred taxes are never discounted. Ind AS 12 clearly says deferred taxes are never discounted. Although it pertains to future, they may reverse in over a period of 5 years, but again, deferred taxes are not discounted, whereas all other provisions may require discounting. So we need to provide disclosure with respect to nature, timing, uncertainties involved, judgment involved, and as well as we need to give proper movement schedule or reconciliation schedule to the provisions opening movements during the period and closing, right? Then government grants in layers 20, we have generally two types of government grants, revenue grants and capital grants. If certain conditions are met, we are eligible to recognize grants in our P&L. Revenue grants recognize immediately, or capital grants are recognized over the useful life of that asset. Generally, non-compliance happens without meeting the conditions. We recognize the grant in our P&L to book the income. Or in case of capital grants, rather than recognizing it over the useful life of the asset, we recognize it upfront, right? In recognizing grant, we need to follow the matching principle. Grant to be recognized in P&L when and only when the matching expense is also hitting my P&L. I cannot recognize grant as an income today, corresponding to which expense will be recognized in the next reporting period, right? In certain conditions, we need to pay back the government grants if all the conditions underlying to that grants are not met. So in that case, we need to create a provision in my P&L, or in case of capital grants, we need to adjust our carrying value of assets. So with respect to those disclosures, it is nature and extent of grants, unfulfilled conditions, etc. So in case of Ind AS 109, so Ind AS 109 talks about categorization of financial assets basis SPPI test and the business model into amortized cost, FVOCI, FVTPL, right? So basis categorization, we need to do the correct accounting for OCI, for FVOCI instrument, the gain and loss should be recognized in OCI, not in P&L, and similarly for FVTPL in P&L, not in OCI. Then we have expected credit loss. We need not to wait for actual loss to happen. Unlike AS era, where bad debts provisions were recognized basis the actual bad debts mostly. But in this is expected credit loss, maybe due to delay in payments, due to risk. The company see that there is a risk in getting the payment, so they need to estimate and recognize expected future credit losses in the P&L today, right? And similarly, we need to disclose all the relevant disclosure for fair value changes for FBOCI, FBTPL assumptions and everything. So one interesting FRRB observation was there, as I mentioned earlier. FBI for the treatment in P&L was correct, right? But in the accounting policy, it was mentioned wrongly that in case of FPTPL instrument, the gain or loss is recognized through OCI. So this is a non-compliance. Maybe we have done the right, but accounting policy and PL presentation are not timed, right? And one more non-compliance, as I mentioned earlier, there are two parts of OCI reclassified to P&L, non-reclassified to P&L. In case of FVOCI instrument, these are shown as will not be reclassified to P&L, right? It is written correctly in the accounting policy, but while presenting the OCI statement, unknowingly or by mistake, it is shown as that will be reclassified to P&L, right? So both are not matching. This is gross non-compliance of Ind AS 109. Then we have Ind AS 41 agriculture. So Ind AS 41 provide detailed guidance for recognition, measurement, and de-recognition, and the fair value as well, right? It gives windfall benefits to the organizations as well. For example, in case of one company into a dairy business, they have cows and buffaloes, right? They give birth to calf, and so there is no cost incurred for those, right? But as they grow, so same need to be recognized at fair value as per the Ind AS requirement. So one of the company recognized a fair value gain of 10 crores because of birth of the calf. And when they grow with respect to their age, the fair valuation gain increases, right? Also, in case of biological assets, in case of crops, there is an initial cost to for that crop, and then all the biological changes in that crop, the crop grows and ready for harvesting. All the changes are recognized in P&L through fair value recognition at each and every reporting date. It includes estimation, judgment, assumption, everything, right? So all those assumptions, estimations, judgments need to be disclosed in the financial statements. Simultaneously, at the time of harvesting of the crop, this is recognized at fair value at the point of harvesting, and that fair value becomes cost for my Ind AS 2 inventories, right? So now this has become cost. Now that inventory will be valued as per the principle of Index 2 cost or NRV, whichever is lower, FIFO method or weighted average method. And then Index 2, the last chapter of my presentation today. So there are certain non-compliances with respect to non-recognition of losses on account of lower NRV. Management ignores or the company ignores the lower NRV impacts or cost is not calculated properly. Admin and selling overheads are included in the inventory cost because inventory directly impacts my profitability. Higher inventory results into higher P&L, right? So overhead should be allocated properly, normal versus abnormal. Then there is a concept of aging obsolete inventory as well as slow moving inventory. We need to create provisions timely basis to show impact of the obsolete and slow moving inventory on my P&L, right? Then choosing the correct cost valuation method, P4 weighted average, and that should be applied consistently. And then the related disclosures with respect to same, right? And certain other items like material items not separately disclosed, we discussed earlier. Yes, one more concept, netting off. Income and expense may be netting off if the offset criteria is met as per the respective standard and disclosure of exceptional items. This need to be in line with Ind AS 1. So this is all from me for today's session. I have covered most of the standards which are very, very relevant for this year end closing, and we should be aware of the compliances.
Thank you, sir. Thank you for such a wonderful webinar. I have few questions asked by our participants. My first question is, in our case, year-end sale include dispatch made on 31st March, but delivery happens in April. How should we determine whether the revenue can be recognized before year-end?
So, very good question. But in this case, the revenue recognition again depends on the contract Incoterms, right? What my contract talks about when the control transfers, whether the control transferred at the dispatch of the goods and all the risk and rewards are now lies with the buyer, or these risk and rewards lies with me. So we need to analyze the contract terms in detail for each and every dispatch. Only then we can say whether we have completed performance obligation or no, and only then we can recognize the revenue.
Okay. My next question is, we have provided post-sale discount based on annual turnover slab, but the final rebate will only be confirmed after year end. How should we estimate and recognize such variable consideration?
Good question. Generally, post-sale discounts happen in case of online sales. For example, a D2C brand like Bella Vita put their inventory with Amazon for further selling through their platform, but due to certain additional discounts, right? After the sale has happened from Bella Vita to the Amazon, there are post-sale discount which need to be estimated and accounted for properly. But again, this is a detailed discussion which cannot be covered in this session,
Okay.
right? So we can connect offline for the same.
Okay. My next question is, if the customer dispute part of the invoice raised before year end, but we still recognize full revenue or adjust it immediately
So
if
the
dispute
five
is
step
raised.
Sure. So the five-step approach clearly says that receiving of consideration should be probable, right? If my consideration is not probable, then it
Okay.
means to that extent I need to evaluate in detail what are the reasons because of which, whether those are administrative reasons but does not impact my delivery of goods, or there is certain issue with respect to the goods, maybe of quality, maybe of quantity, grade, or whatever it is, right? So we need to go into the details of those dispute, administrative or the delivery or the quality or the quantity, only then we can recognize the revenue once the assessment is done.
Okay. How should we account for unbilled revenue where the service are sustainably completed but not yet invoiced as of 31st March?
Right. So we discuss about contract assets. We have delivered the goods, but invoicing is not done, right? So I cannot recognize my revenue because the basic conditions for revenue I have not complied with, right? So this is recognized as a contract asset. And as soon as I raise the invoice, I can recognize the revenue and the corresponding trade receivables because the trade receivable has to be unconditional. If there is a condition attached to trade receivable, then it means I cannot recognize the revenue as well.
Okay. The employee bonus are approved after year end but relates to the current year performance. Should we create a provision as on 31st March?
This is a very good question. Whoever has raised this, Neenal, even in my one of my organization, I have seen this. They were having a practice of recognizing the revenue in the year in which it is declared. But as
Okay.
per Ind AS or IFRS, we need to create a provision because it pertains to the performance of the employees giving criteria which they have performed for the year just ended. So management need to create a provision basis, judgment basis, best estimates and assumptions and the past history in the same year to which it pertains. It cannot be delayed to the next year. It will result in auditor qualification as well
Okay.
as a non-compliance.
Okay. In case of vendor invoice not received before year end, what level of estimation is considered sufficient for expenses recognition?
So if only invoice is not received, but a contract is in place, the terms and
Okay.
condition, the price, everything is defined there, right? So there are no much uncertainty. I believe there is no much uncertainty exists relating to this recognition. So we need to do a reliable estimate and recognize a provision for the same.
Okay. My last question is, if the contract modification are agreed close to year end, but the formal documentation is pending, can we account for them in the current year?
No, so again, if we want to account for them, whether those modifications can be justified with the auditors or to the audit committee or to the board, right? We discuss something, right? But until and unless it is formally documented with a vendor, document may be over emails, right? There has to be underlying document. It may be over emails, certain emails, and emails has to come from the person who has authority, who has the right to execute that. If that is there, all the evidences are in place, then that is only a legal formality. But if that needs approval, the final approvals are still not there. The person who have exchanged email has not authority, has not the final authority to execute those modifications. Then it means the underlying documentation is not there.
Okay, sir. Thank you. There is no more question. Thank you so
Thank you.
much.
Thank you, Nina.
Thank you for Sanjeev sir and Shalini ma'am, Rahul sir, and whole team of ICAI. And special thanks to the all participants. I hope there is no question in the mind of participants. If there is any question, may directly contact to our speaker, CA Rahul
Sure.
sir. Thank you. Thank you so much.
Thank you. Thank you, Minal.